I mean, everybody thinks wrongly that the Fed can always control interest rates and introduce yield curve control and things like that. That is not the case. In normal times, when things are not too challenging, yes, they can do that. But we now have a situation where debt to GDP in the US is well over 100%, 125% or whatever, depending on what your view of GDP is. We've got high GDPs all the way around the world in all the G7 countries now. We're looking at an average of 100 or maybe slightly more. I mean, France is about 110, I think. UK is about 100. Germany is a bit lower, but they've just raised their debt limits because they spend money buying military equipment off the Americans to expend in the Ukraine. They're all very highly indebted, and these are debt traps. I mean, by definition, when you find that economies are stagnating and debt is still growing, it's debt which is not being deployed productively by any stretch of the imagination. You're looking at something which is actually just eventually going to collapse. Central banks can delay things, they have delayed things, but I think this one is getting out of their control. I really do. I mean, the Fed has already effectively admitted that it can't fund out along the yield curve. It's tried to and found that auctions have been disappointing, to use the recurring phrase. The only funding they can really do for the US Treasury really is short term. I mean, it's less than 5 years, certainly less than 2 years. And, really it's a reliance on T-bills. And this is why there was this debate within the Fed, including input compliance vis-a-vis Basel III, as to whether they could get rid of the supplementary leverage ratio, or reduce it anyway, which would give the banks room to buy more T-bills. The banks are willing to do it because all the regulators tell them that the risk-free investment is a T-bill, and the banks don't want risk. They see things out there which I don't think they would really want to admit to. Occasionally you get Jamie Dimon standing up and saying something which is rather controversial, but I reckon that the bank's internal research on the state of the US economy, I think, shows that things are just not good. So they don't want to lend money all around the country, and I think this is partly why they seem to be quite happy to puff up financial market by directing bank credit in that direction. And the result is you've got over $1 trillion, according to FINRA, being lent to margin players in the equity market. This is very, very much end of era stuff. It really is. And it matches so much. And what's really worrying, actually, about all this is that if you look at equity, traditionally, you look at equities versus long bonds. That has always been the way in which investors look at it. And the regulators, I don't know about in America, but over here, the regulators will say, low risk is 60% bonds, 40% equities, medium risk is 50-50, whatever, and high risk is, say, 70% equities, 30% bonds, whatever. That is the sort of portfolio structure they talk about. In other words, it's a relative valuation story, risk. And as a result, what you've got to do is, you've got to think in terms of what is the yield on the long bond and what does that mean for equity markets. So one way or the other, I think that what we've got the conditions, if you like, for the end of this current run in the equity market. And if you get long bonds rising even further, then it's definitely going to be very, very bad for equities. And the other thing I would say is that these conditions are very similar to what we saw in 1929. I mean, you had the Roaring Twenties, credit boom, which was nothing as big as this one, incidentally. And then you had Smoot-Hawley Tariff Act in 1930. I mean, it was being debated in Congress in 1929, finally signed into law by President Hoover in early 1930. What have we got today? We've got Smoot-Hawley Mark II in the form of Donald Trump's, tariff tantrum, or whatever you like to call it, coupled with the biggest credit bubble in history. This is going to make 1929 look like a tea party, potentially. And now we're talking about bond yields rising from here. Oh dear.
Oh dear, indeed. Why do you say that this thing could unwind within weeks? What makes it so urgent? Can they not kick the can down the road a bit further?
Well, I mean, one of the problems in this is that if it was just one nation in trouble, then I think the others could rally round. You get, I mean, let's say it was a problem for the Bank of England, which it is, but nobody else had quite that problem. You would have swap lines being, sort of quietly put in place and all the rest of it, because other central bankers will be aware of the problems. But this one is everywhere. This problem is everywhere. It's not just something starting somewhere, and maybe if it's mishandled, it's going to have knock-on effects elsewhere. It's not like that. It is everywhere. I mean, at the end of the day, there's the old market phrase. You would say the markets always win out at the end. And yeah, okay, we've been kicking the can down the road really since the 1960s. And the first sort of blip in that was the end of Bretton Woods. I mean, it started off with gold pool failing and all this sort of stuff. They're trying to sort of keep the thing up, as it were. And they've kicked the can down the road. I mean, they've devalued the dollar, measured against real money, from $35 an ounce in 1971 to around about $3,400 today. I mean, like it's lost 99% of its value virtually. That's what's happened to the dollar, and it's even worse.
Let us start with a rather uncomfortable truth, and one which is increasingly obvious to anyone with their eyes open. Central banks are not omnipotent. We have been conditioned to believe that the Federal Reserve can always bend interest rates to its will, that it can conjure liquidity out of thin air, and that the magic wand of yield curve control will forever keep the machine humming. This, I assure you, is a dangerous fallacy. Yes, in quiet times, when debt ratios are manageable, when economies are growing in a steady, if not spectacular fashion, and when trust in the currency is broadly intact, central banks can get away with the illusion of control. But when debt to GDP surpasses 125% in the United States and hovers at or above 100% across the G7, when governments are spending with the abandon of gamblers in Monte Carlo, and when debt is compounding while growth stagnates, then the illusion cracks. The market begins to reassert itself. Consider this. France's debt to GDP is around 110%. The UK is flirting with 100%. Even Germany, long considered the fiscal anchor of Europe, has loosened its belt, raising debt ceilings to finance purchases of American weaponry for a proxy war in Ukraine. These are not outliers. They are the mainstream. And in such conditions, debt ceases to be a tool for growth and becomes instead a trap, a debt trap. Once an economy is in this position, central banks can delay the reckoning, perhaps for years, but they cannot prevent it. The mathematics of compound interest and stagnant productivity will always win in the end. The Federal Reserve itself has already admitted its limits. It cannot successfully fund along the yield curve. Its attempts to auction long-dated treasuries have been disappointing, to use their sanitized language. Buyers are scarce. Foreign central banks are net sellers. Pension funds and insurers are nervous, which leaves the Fed funding primarily through short-term T-bills, maturities less than 5 years, often less than 2, a rollover treadmill of debt. Now think about what that means. America has $34 trillion in outstanding debt, with $28 trillion of it rolling within a few years. Add an annual deficit of $3 trillion, and you're compounding an already unsustainable pile. Against $5 trillion in annual tax receipts, the arithmetic simply doesn't work. You can tax the rich, you can tax the middle class, you can squeeze every last drop from productive enterprise, and you will still be short. So what happens? Banks pressed into service are encouraged, one might say coerced, into holding more short-term government paper. The regulators tell them, "Don't worry, T-bills are risk-free." Risk-free. Tell that to anyone who's lived through a sovereign debt crisis. The banks comply, but reluctantly. They see what's happening. Jamie Dimon himself occasionally blurts out truths that his peers keep to themselves. They see the rot in the real economy. They see the malinvestment. They see that this isn't a cyclical downturn. It is structural decay. And rather than lending into the productive economy, which carries risk because small and medium businesses may not survive, banks prefer to inflate financial assets. Over $1 trillion, according to FINRA, is now being lent on margin into equities. In other words, Wall Street has become the playground of last resort, puffed up by cheap leverage while the Main Street economy withers. This, I submit, is very much end-of-era behavior. We have seen this before. Go back to the Roaring '20s. Credit expansion fueled a giddy rise in stocks. Leverage was rampant. And then, in 1930, along came the Smoot-Hawley Tariff Act, a monument to economic ignorance, choking off global trade at precisely the wrong moment. The combination of a credit bubble and protectionist tariffs turned what might have been a sharp but manageable downturn into the Great Depression. Does that ring any bells? Today we have the biggest credit bubble in history, dwarfing the 1920s, and we have Donald Trump's tariff tantrums looming once again. Call it Smoot-Hawley Mark II. And this time, the stakes are higher because the bubble is global, not confined to Wall Street. The ECB, the Bank of England, the Bank of Japan, they are all in the same leaky boat. Now, some people ask me, but Alasdair, can't they kick the can down the road a little further? Haven't they always? Yes, they can. And yes, they have. The entire post-war monetary order has been an exercise in can kicking. When the London gold pool failed in the 1960s, the United States devalued the dollar against gold in 1971. Since then, the dollar has lost 99% of its value relative to gold, from $35 an ounce to roughly $3,400 today, a long, slow-motion default.
Bearing in mind that what we're looking at, if you like, is a chart which is measuring risk in credit. Now, if we get, as the other charts on long bonds indicate, if we get higher bond yields at a time when governments are over-indebted, in other words, they're going into debt traps, or put yet another way, the currencies, the bond markets are in a state of collapse, then the risk in bonds basically will be reflected in a higher gold price, because people will be getting out of not just bonds but currencies as well, on the margin anyway, into real corporeal money, which of course is gold. This consolidation basically over the summer months, I think makes sense, if you like. Everything else has rather been on pause. If you looked at things like, the 10-year US Treasury, I mean, that's sort of moving sideways. It's gone down a little bit. I mean, the yield's gone down a bit, etc., etc. So, there's nothing to see, move along sort of thing. And I think that's really been reflected in a consolidation in gold. But the pattern there is interesting, because as a technical pattern is like a pennant. Basically, a pennant is one where you've got two sides which converge in together. In this case, the top side is absolutely flat, and you've got a rising bottom to the pennant. And that is actually quite bullish when it breaks out. It rather indicates that the consolidation has been knocking to try and get out, and eventually it will get out. And of course, the moving averages have all caught up with it, and so on. So, but the underlying momentum, bull market momentum, is still there. And bearing in mind that what we're looking at is risk in currencies, currency risk increasing, the loss of purchasing power, etc. Because what's going to happen with these rising bond yields is not commodity prices falling or anything like that. No, certainly not. It's a reflection, if you like, of the growing risk in these currencies. People are trying to get out of currencies. That is why bond yields are going up. They're all in debt traps. And that really means that eventually gold will break out on the upside. And I guess it will coincide with quite a sharp move upwards in long bond yields. And I don't think that time is very, very far away. I think it could be a matter of weeks, literally, rather than months. Well, the answer basically is we're in a debt trap. It's just getting worse and worse and worse and worse. We had the same situation in this country back in 1975, when we had, again, a far-left socialist government who refused to cut spending and talked about increasing taxes even further. They were even talking about wealth taxes and all the rest of it. I mean, I remember that. The Chancellor of the day, Dennis Healey, was threatening people, the rich. He was going to squeeze them until the pips squeak. That was his phrase, and it's that people remember that. That was the whole thing. And we got exactly the same situation today. Now, what happened in those days was we had a sterling collapse, which America kindly rescued us. They came in and bought sterling, supported it so that, the bears were squeezed and all the rest of it, panic over in the sterling market for the moment. But in order to close their long position, they sent the IMF in.
First, we must recognize that when the reckoning arrives, it will not be a localized crisis. This is not Britain's pension system wobbling in 2022 or Italy's bond market needing quiet support. This will be systemic. The debt to GDP ratios of the G7 are all in the triple digits. The monetary authorities are all engaged in the same delusion, that you can solve a debt problem with more debt. When that delusion collapses, it collapses everywhere. History gives us clues. In 1931, the credit Anstalt failure in Austria triggered a domino effect across Europe. In 1997, the Thai baht crisis spread through Asia. In 2008, subprime mortgages in Nevada and Florida toppled global finance. Small sparks, global fires. But this time, the spark will be in the sovereign bond market itself, the foundation of the entire system. When treasury auctions fail, when gilt yields spike uncontrollably, when the bund ceases to be risk-free, then the cascade begins. And governments, make no mistake, will not sit idle. They will reach for the usual toolkit of repression. Capital controls will reappear. Already, Europe has flirted with banning cash transactions above trivial thresholds. In a crisis, such bans will multiply. Expect limits on moving money abroad. Expect new taxes on excess profits. Expect wealth taxes dressed up as patriotic contributions. Expect, too, that governments will seek to corral pension assets, forcing them into government bonds. Most ominously, expect gold to be targeted. Not because it is irrelevant, as the academics sneer, but because it is essential. Every central bank in the West already carries a gold revaluation account on its balance sheet. They know perfectly well what tool is available. In 1933, Roosevelt confiscated gold, devalued the dollar by 40%, and instantly improved the Treasury's balance sheet. In 1971 to 73, Nixon severed convertibility and repegged the book value of gold at $42.22 an ounce, where it absurdly remains today. To this day, the Fed values its gold at that price, even as the market price is over $3,400. Now imagine the arithmetic. Revalue gold not to $42 but to $10,000 or $24,000, as Jim Rickards has suggested based on money supply ratios. The Treasury instantly creates trillions in accounting gains. That strengthens its balance sheet and, at least temporarily, restores confidence. Bank of America's Michael Hartnett has said outright that central banks will be forced to revalue gold reserves to reduce debt burdens. Francisco Blanche calls gold a key asset for central banks. These are not gold bugs. These are mainstream strategists whispering the truth. The question then is not whether gold will be revalued. It is how and under what conditions. Will it be explicit as in 1933 or implicit as in 1980 when gold surged until it covered the Fed's balance sheet 100%? My suspicion is that the market will do it first and the authorities will ratify it after the fact. They always prefer to appear in control, even when dragged kicking and screaming by reality. Now, let us think about silver. I must confess I have a particular soft spot for silver because it is always treated as the neglected cousin, the industrial commodity, the speculative plaything. But history tells us otherwise. For centuries, silver was the people's money. The crime of 1873, the demonetization of silver in favor of the gold standard, was nothing less than a transfer of purchasing power from the middle class to the wealthy, who stored wealth in gold. By demonetizing silver, government stripped money from the many and concentrated it in the hands of the few. And yet, silver never went away. It remains essential in industry, in solar panels, electronics, water purification, and increasingly in green technologies. More silver is consumed than produced every year. Recycling cannot bridge the gap. Above-ground inventories are being drawn down relentlessly. If gold is the sovereign's hedge, silver is the people's hedge. And when the credit system buckles, silver's monetary role will be rediscovered. I believe we are heading toward a reversion to the historic 15-to-1 gold-silver ratio. Today it stands closer to 80-to-1. That gap will close not because silver is suddenly fashionable, but because markets will recognize that silver too is money and its scarcity is extreme. Now, some of you watching this may be thinking, yes, but what about digital currencies? What about central bank digital currencies, CBDCs? Indeed, they are coming. The Fed is openly testing FedNow. The ECB is experimenting with the digital euro. China already has its digital yuan. But let us be clear, a digital dollar is still a dollar. It does not cure the debt trap. It does not solve the compounding interest burden. It merely makes surveillance and control easier. It is an extension of fiat, not a replacement of it. And if the underlying currency is collapsing, digitizing it will not save it. You can dress up a corpse, but it's still dead. What about Bitcoin? Here, I know opinions diverge. Bitcoiners argue that it is incorruptible, finite digital gold. And in some ways, they are right. It cannot be printed. It has a predictable supply. It is outside the banking system. But it is also volatile, untested in a true systemic crisis, and subject to regulatory choke points at the fiat on and off ramps. Will Bitcoin survive the storm? Perhaps, but I have no doubt that gold will. Gold has survived every storm for 5,000 years. Bitcoin has survived 14. The comparison is premature. Let me now address the question of timing. Why do I suggest that this could unravel within weeks? Because the bond market is already rebelling. Treasury auctions are weak. Long yields are drifting higher despite the Fed's jawboning. Equity valuations are stretched to extremes, priced as if interest rates will never rise again. Margin debt is at obscene levels. All the ingredients of a crash are in place. The only missing element is the trigger. And triggers, by definition, are unpredictable. It could be a failed auction. It could be a geopolitical shock. It could be a bank failure. Once the trigger comes, the cascade will be swift. This is not to say the world ends. Far from it. Societies survive, economies rebuild, but the monetary order will shift. The dollar's exorbitant privilege as reserve currency is already under assault. BRICS nations are building alternative payment systems. Bilateral trade in yuan and rubles is rising. Saudi Arabia flirts with accepting non-dollar oil payments. All of this points to a multipolar world where gold reasserts itself as the neutral settlement asset. And here is the final irony. The West, which has mocked gold for half a century, may be forced to revalue its own gold reserves simply to remain relevant in that new order. Imagine Washington reluctantly admitting that its balance sheet requires gold at $10,000 an ounce. Imagine the ECB doing likewise. Imagine Japan, drowning in debt, suddenly discovering that its gold is worth vastly more. These are not wild fantasies. They are the logical endgame of arithmetic. For you, the individual saver and investor, the lesson is clear. Do not wait for permission. Do not wait for the headlines. Accumulate real money now. Physical metal, not paper claims. Because when the crunch comes, paper will default, contracts will cash settle, and only metal in your possession will matter. And let me add this, it is not about getting rich quick. It is about preserving purchasing power, about surviving the reset with dignity and independence. In the 1930s, those who held gold were not made fabulously wealthy. They simply avoided ruin. That alone was a triumph. We stand today at a similar juncture. The roaring 20s of credit are ending. The tariffs of Smoot-Hawley are returning. The debt traps are everywhere. And just as in 1929, the market will not be cheated forever. So I urge you, think clearly, act prudently, and prepare accordingly. The system is wobbling. The dam is creaking. The flood is coming. Gold and silver are your lifeboats. Step into them now before the waters rise.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.